Hello, this is Erin Donovan coming to you on behalf of the DART Network. I am a CPA with a master's in business taxation, and today we're going to be going through some tax considerations for independent contractors. Please note that this presentation is for educational purposes, and we are not providing accounting, tax, or other professional advice because this presentation does not take into account any of your specific facts and circumstances. This presentation takes into account U.S. federal income tax laws in effect as of July 2022, and the intended audience is DART Transit Company, employees and independent contractors, and this is not intended for any other individuals. Our agenda today is going through tax considerations for independent contractors that include the following topics. Today we're going to be talking about Schedule C reporting, income tax deduction items, tax credit opportunities, a high-level review of income tax rates, tax computations, and some other considerations. The first topic that we're going to be discussing today is Schedule C. So as an independent contractor, Schedule C is where you will be reporting the income and deduction items associated with your activity as an independent contractor. So first, you will report the gross income amounts that you received related to your business, as well as the various expenses that you incurred during the year. It's important that you maintain records to document the expenses that you are claiming. This would include receipts, credit card statements, bank records, etc., to support the expense amount in the event that you were to receive a question from a taxing agency. We listed some common expenses on the slide, which would include business-related meals, lodging expenses, licenses, tractor lease expenses, and really any other expense that you have that's attributed to your business as an independent contractor driver. Some other considerations relating to this activity would be quarterly estimated tax payments, as well as the potential benefit of the qualified business income deduction, which we'll discuss in additional detail later on throughout the slides. The next slide is talking about common deduction items that relate to taxpayers. These deductions are not exclusive to independent contractors, but rather all taxpayers. As part of the Tax Cuts and Jobs Act that was passed back in 2017, there was significant changes to the standard deduction. It was essentially doubled, which has resulted in many taxpayers no longer itemizing their deductions, but rather taking the standard deduction. So on this slide, we have listed out the current standard deduction for various taxpayers. So for a taxpayer that is filing a married filing joint return, the deduction right now is almost $26,000. And for a single taxpayer, the deduction is $13,000. This is a deduction that reduces your overall adjusted gross income for purposes of determining your taxable income when computing the amount of income tax that you owe. Now, taxpayers are allowed to take a deduction for the higher of either their standard deduction or their itemized deductions. You may want to consider itemizing your deductions if you have home mortgage interest to claim, if you made gifts to charity throughout the year, and if you paid state income tax and or property taxes during the year, as well as if you had unreimbursed medical expenses. There are some limits on itemized deductions. For example, the deduction for state and local income taxes and property taxes is capped at $10,000. And medical expenses are only deductible if they exceed a certain percentage of your adjusted gross income. So when deciding which deduction to take, you would want to add up all your possible itemized deductions and compare that to the standard deduction. And whichever one is the highest, that's the deduction that you would want to take on your personal return. In addition to this, there is also the possibility of a deduction for making contributions to an IRA. Currently, the contribution limit is $6,000 per taxpayer and an additional $1,000 per tax year for taxpayers that are age 50 and older. These are the limits for 2022. So an individual that's 51 years old could make a contribution to their IRA of $7,000 for tax year 2022. Depending on your personal tax situation, you would want to decide whether you want to contribute this amount to a traditional IRA, which could result in a tax deduction, or contribute the amount to a Roth IRA, which would not allow for a tax deduction today, but the growth in that account, as well as future distributions out of the Roth account, would likely not be subject to income tax. So far we've talked about various deductions that might be available to you in computing your taxable income, and we've also walked through the reporting of your Schedule C income and expense items related to being an independent contractor. Next, we wanted to touch on various tax credits that might be available to you. This includes the Child and Dependent Care Tax Credit, the Child Tax Credit, the Earned Income Credit, and the Retirement Savings Contribution Credit. The Child and Dependent Care Credit is a credit that's available for eligible dependent care expenses for qualifying individuals. This credit is a 50% credit up to $8,000 of expenses for one child and up to $16,000 for two or more children. So this would result in an income tax credit of $4,000 for one child and up to $8,000 for two or more children. This credit is subject to an income phase-out. In addition, there's the Child Tax Credit. The Child Tax Credit is a credit available for up to $2,000 per qualifying child under the age of 17. Further, there's an additional $500 per dependent credit that is available as well. Again, this credit is also subject to a phase-out when adjusted gross income hits a certain level. The Earned Income Credit is another credit that could potentially be available to you. This credit allows for a maximum amount of just over $6,700, and it's based on the number of qualifying children that a taxpayer has, as well as the income of the taxpayer. Finally, we also wanted to touch on education credits. So there are currently two available education credits for taxpayers: the American Opportunity Tax Credit and the Lifetime Learning Education Credit. Both of these credits are subject to a phase-out based on the adjusted gross income of the taxpayer. In addition to the education tax credits, some states allow for either a tax credit or a tax deduction for contributions made to a 529 plan. Currently, there is no benefit at the federal level for these contributions when made. However, you should consult with your tax advisor to see if your state allows for any tax benefits. On the next slide, we put together a simplistic table showing the current tax rates for various taxpayers. So in this case, we've listed out single taxpayer as well as taxpayers that are filing married, filing joint. And what we're showing is at various taxable income levels, what is the income tax rate for federal tax purposes at those income levels. This will help you gauge, based on your projected income during the year, approximately how much you may end up paying in federal income tax. In addition to this, we've outlined the self-employment tax that you will owe on your net income associated with being an independent contractor. This includes the Medicare tax, which is 2.9%, as well as the Social Security tax, which is 12.4%, up to the FICA limit, which is currently at $147,000 of wages and/or self-employment income. For self-employed individuals, independent contractor drivers, you do receive a deduction of 50% of the amount of payroll taxes that you paid against your income tax liability. Let's go to the next slide and walk through an example. So in this example, John and Mary are a married filing jointly taxpayer. They have a Schedule C self-employment income of $60,000 relating to their activity as an independent contractor. Their total itemized deductions do not exceed the standard deduction, and they have no children. Their federal income tax computation is outlined on the slide. So in their case, they start with their income of $60,000 and compute their self-employment tax. They then compute their taxable income by taking their total income of $60,000 less the deduction for 50% of their self-employment tax, less a deduction for the qualified business income deduction. If you recall, we talked about that earlier in the presentation. The qualified business income deduction is a temporary deduction that was passed as part of the Tax Cuts and Jobs Act, and it allows for certain taxpayers, including Schedule C self-employed taxpayers, to take a deduction of 20% of their income when computing their taxable income. In this case, based on the income threshold limitation, John and Mary qualify for this 20% deduction. So in computing their adjusted gross income, they take the $60,000 less the deduction for their self-employment tax, less the deduction for the qualified business income deduction, which equals roughly $44,000. And from that, they reduce their adjusted gross income by the standard deduction of $25,900 to come up with their taxable income. Their taxable income, as you can see on the slide, is at $18,709. They are in the 10% federal income tax bracket, so they would pay 10% in income tax on that $18,000, in addition to the self-employment tax that was computed above. Their total income and self-employment tax in this example equals $10,349. Now let's walk through another example of a tax computation. So in this case, Tim and Sue, again, are married, filing a joint income tax return. In this case, they have net income of $90,000 from the activity of being an independent contractor, which is self-employment income. Again, their deductions outside of their business deductions do not exceed the standard deduction. So again, they're not itemizing. They're not taking a deduction for mortgage interest, property taxes, and charitable donations, because those amounts do not exceed the standard deduction of $25,900. And they also have no children. So in this case, again, they're taking the standard deduction of the $25,900. And they first need to compute their self-employment tax on the $90,000 of self-employment income, as well as then the related income tax. So again, we're going to start with the $90,000, and we're going to take that multiplied by the amount that's subject to the self-employment tax. And that results in self-employment tax of about $12,717. Again, half of that qualifies as a deduction for purposes of computing their taxable income. Tim and Sue also qualify for the qualified business income deduction, which is a 20% deduction of their net self-employment income. So that results in a deduction of a little over $16,700. So in computing their adjusted gross income, you take the $90,000 less the 50% deduction for the self-employment tax, less the qualified business income deduction, which results in adjusted gross income of $66,913. Now, to compute their taxable income, we take the $66,000 less the standard deduction, resulting in taxable income of $41,013. We go back to our tax rate schedule, and they are in the 12% federal tax bracket, and we use that to compute their income tax, which ends up being $4,511. So we take the $4,511 plus the $12,717 of self-employment tax to arrive at their total tax liability, which is $17,228. Now again, reminder that in both of these examples, there are no children involved. So to the extent that either taxpayer groups had children, they could potentially reduce this liability by the child tax credit and potentially the child and dependent care credit. Let's go to the next slide. So some other items to be considering is if you expect that your tax liability will be at least $1,000 for the tax year, after subtracting any withholding or refundable credits that you might have, you may be required to make quarterly estimated tax payments. If you do not make quarterly estimated tax payments, you could be subject to underpayment penalties. Quarterly estimated tax payments are due April 15th, June 15th, September 15th, and January 15th. As we approach year end, a couple things for you to be considering. Consider maxing out your IRA and HSA contributions, if eligible. To the extent that you have a spouse that is an employer and is eligible to participate in flexible spending accounts or dependent care spending accounts, be sure to use those amounts up and seek reimbursement before year end. And start gathering your tax documents to prepare your next year's income tax returns, receipts, dependent care expenses, charitable givings, etc. So you have all that ready to go when it's time to prepare your income tax return. To recap, today we discussed Schedule C reporting for an independent contractor, as well as deductions that all taxpayers are eligible for, including the standard deduction or the itemized deductions. We've talked about various tax credits, current federal tax rates, and some example tax computations. We hope that you found this session to be helpful. Thank you for your participation.